The cryptocurrency market is in a lull, prices are down, enthusiasm has waned, headlines scream of scams and crashes, but this is not a time for panic. This is a time for opportunity. Savvy investors understand that market cycles are inevitable. What goes down must come up. And when it comes to crypto, the potential upside is enormous. Now is the time to research, to learn, and to position yourself for the next bull run. To understand the present, we must look to the past. The cryptocurrency market is cyclical. Periods of rapid growth are followed by corrections. This is normal. This is healthy. It's the natural ebb and flow of any emerging market. Look at the dot-com bubble of the late 1990s. Many companies crashed and burned, but from the ashes rose giants like Amazon and Google. The journey of cryptocurrency began with the Genesis block of Bitcoin mined by Satoshi Nakamoto in 2009. This marked the inception of a revolutionary idea that would challenge traditional financial systems and introduce a new way of thinking about money. This event marked the birth of a new era in digital finance, introducing the world to the concept of decentralized money. It was a radical departure from the centralized banking systems that had dominated for centuries. In these early days, crypto was primarily a niche interest among tech enthusiasts and libertarians. They saw it as a tool for financial freedom and privacy, a way to break free from the control of traditional financial institutions. Its value was negligible in traditional financial terms, with the first notable transaction being the purchase of 2 pizzas for 10,000 bitcoins. This transaction, often referred to as Bitcoin Pizza Day, has since become legendary in the crypto community. This period was characterized by exploration and experimentation. Developers and users alike were testing the limits of what this new technology could do, often with little regard for immediate financial gain. As Bitcoin began to gain recognition, other cryptocurrencies emerged, such as Litecoin and Ethereum, each proposing enhancements or differing functionalities. Litecoin aimed to offer faster transaction times, while Ethereum introduced the concept of smart contracts, enabling more complex and programmable transactions. These early altcoins paved the way for a broader understanding and acceptance of what blockchain technology could offer beyond just a digital currency. They demonstrated that the underlying technology had applications far beyond simple transactions, including decentralized applications and services. It was a time of idealism and innovation, where the community was small but highly engaged, focusing on potential rather than profit. These pioneers were driven by a vision of a decentralized future, where power and control were distributed rather than concentrated. The year 2018 remains a watershed moment in the history of cryptocurrency, often compared to the dot-com bubble burst at the turn of the millennium. After reaching unprecedented highs in late 2017, the market experienced a dramatic crash, with Bitcoin plummeting from nearly $20,000 to below $4,000. This decline sent shockwaves across the entire crypto space, resulting in significant financial losses for many investors. However, this event was not just a downturn. It was a crucial restructuring of the market's foundation. This crash served as a reality check, weeding out speculative excess and many unsustainable projects. It forced the crypto community and investors to shift focus from mere price speculation to the underlying technology and its practical applications. Projects that survived this period had to demonstrate real-world utility and robust business models, leading to a healthier, more sustainable ecosystem in the long run. In this section, we delve into the historical market cycles in cryptocurrency, exploring the intricate patterns that have emerged over the years. Cryptocurrencies exhibit distinctly pronounced market cycles compared to traditional financial assets, often characterized by extreme volatility and rapid shifts in market sentiment. These cycles often entail rapid growth phases, followed by sharp corrections, a pattern that can be disorienting for the uninitiated. The dramatic rise and fall can be attributed to various factors, including technological advancements, regulatory news, and market speculation. By examining these historical cycles, investors can gain insights into the possible triggers and durations of these fluctuations, which is crucial for strategic planning and risk management. Understanding these patterns can help investors make more informed decisions and potentially mitigate risks. The first noted cycle occurred after the 2011 media attention that drove Bitcoin's price from mere cents to $31, only for it to crash back down to $2. This dramatic rise and fall marked the beginning of a new era in digital finance. This cycle was driven by increased public awareness and the novelty of digital currency, capturing the imagination of early adopters and speculators alike. Subsequent cycles, including those in 2013 and 2017, followed similar patterns of media-driven hype and subsequent corrections. Each of these cycles brought new participants into the market, further expanding the ecosystem. Each cycle, however, has laid down a new baseline for the market, higher than the previous ones, showcasing gradual, albeit volatile, growth. This upward trajectory, despite the volatility, indicates a maturing market that continues to evolve and adapt. Now let's delve into Section 4, Understanding Low Runs for High Potential. The concept of buying the dip might seem straightforward, but executing it effectively requires a nuanced understanding of what constitutes a low run versus a temporary market correction. It's not just about seeing a drop in prices and jumping in, it's about recognizing the underlying patterns and signals that differentiate a genuine low run from a fleeting market fluctuation. A low run in the crypto market is typically characterized by prolonged periods of depressed prices, low trading volumes, and a general market sentiment of pessimism. These periods can last for weeks, months, or even longer, and they often test the patience and resolve of investors. This can be seen as an opportune moment for potential investors, but it requires careful analysis to distinguish from mere volatility. Volatility can be short-lived and driven by temporary news or events, whereas a low run is more sustained and often driven by deeper market forces. Low runs are often the result of several factors, including macroeconomic conditions, regulatory changes, or significant shifts in technology. For example, a downturn in the global economy can lead to reduced investment in cryptocurrencies, causing prices to drop. For instance, the increased adoption of blockchain technology in industries like finance and logistics could lead to long-term shifts in crypto valuation. As more companies and sectors integrate blockchain, the demand for certain cryptocurrencies could rise, potentially reversing a low run. Similarly, tightening regulations in major economies can cause temporary downturns. These regulatory changes can create uncertainty and fear in the market, leading to sell-offs and price drops. Analyzing these factors can help investors identify whether a low run presents a genuine buying opportunity or a potential risk. By understanding the root causes and the potential for recovery, investors can make more informed decisions and potentially capitalize on low runs for high returns. In this section, we explore decentralized finance, or DeFi, the future of money. DeFi is more than a buzzword. It's a revolution. Imagine a world without banks, a world where you control your own money. That's the promise of DeFi. DeFi uses smart contracts to automate financial services. Lending, borrowing, trading, all done without intermediaries. This means lower fees, faster transactions, and greater transparency. Section 2, The Rise of Web 3, Beyond the Browser. Web 3 is the next iteration of the internet. It's about decentralization, ownership, and user empowerment. Where Web 2 gave us social media giants and data monopolies, Web 3 gives us back control. Imagine owning your online identity, earning rewards for your data, and envisioning a truly open and democratic internet. Section 3, Metaverse Mania Hype, or the next big thing. The metaverse is a persistent, shared 3D virtual world. It's a place where people can interact with each other, participate in experiences, and create and trade digital assets. Think Ready Player One, but with real economic opportunities. The metaverse is still in its early stages, but the hype is real. Facebook's rebranding to Meta sent shockwaves through the tech world. Section 4, Green Crypto, Sustainability Meets Blockchain. Cryptocurrency has an energy problem. Bitcoin mining in particular consumes a significant amount of electricity. This has led to criticism from environmentalists and calls for greater sustainability in the crypto space. Fortunately, the good news is that the industry is listening. Section 1, Navigating the Crypto Maze, a beginner's guide. Entering the world of cryptocurrency can feel like stepping into a labyrinth. It's a complex landscape with its own language, technologies, and risks. But don't be discouraged. With a little guidance, anyone can navigate this exciting new world. Start with the basics. Learn about blockchain technology. Understand the different types of cryptocurrencies. Familiarize yourself with the key concepts like wallets, exchanges, and private keys. Section 2. Risk and Reward. Treading carefully in crypto waters. Cryptocurrency offers the potential for high rewards, but it also comes with significant risks. Understanding these risks is crucial for any investor, especially beginners. One of the biggest risks is volatility. Crypto prices can swing dramatically in short periods. This can be exhilarating for some, but it can also lead to significant losses. Another risk is security. Cryptocurrency is a prime target for hackers. Exchanges can be hacked, wallets can be compromised. It's essential to take steps to protect your investments. Use strong passwords. Enable two-factor authentication. Store your crypto securely, either offline or with a reputable custodian. Section 3. Diversification. Don't put all your eggs in one basket. Diversification is a fundamental principle of investing. It's about spreading your risk across different asset classes. This is especially important in the volatile world of cryptocurrency. Don't put all your eggs in one basket. Instead, diversify your portfolio across multiple cryptocurrencies and investment strategies. One way to diversify is by market capitalization. Large-cap cryptocurrencies like Bitcoin and Ethereum offer greater stability and liquidity. Mid-cap and small-cap cryptocurrencies offer higher growth potential, but also come with higher risks. By investing in a mix of market caps, you can balance risk and reward. Section 4. The future is decentralized, embracing the crypto revolution. Cryptocurrency is more than just an investment opportunity. It's a technological revolution that's changing the world. It's about decentralization, empowerment, and innovation. It's about creating a more open, transparent, and equitable financial system. The future is decentralized, and cryptocurrency is at the forefront of this movement. We're still in the early stages of this revolution, but the potential is immense. Cryptocurrency has the power to disrupt traditional industries, from finance to healthcare to supply chain management. It can empower individuals, giving them greater control over their data and their finances. And it can foster innovation, creating new opportunities for entrepreneurs and developers. Section 1. Riding the crypto wave. Embracing the next upswing. As we've explored, the cryptocurrency market operates in cycles. Periods of rapid growth are often followed by corrections, creating what we call low runs. These downturns, while potentially unnerving, are a natural part of a maturing market. They present unique opportunities for those who understand the cyclical nature of this innovative asset class. Remember, fortune favors the prepared. The current market lull shouldn't be seen as a deterrent, but as a chance to position oneself for the next upswing. By learning from historical patterns, identifying promising technologies like DeFi and Web3, and employing sound investment strategies such as diversification and risk management, you can navigate these turbulent waters effectively. Think of it as surfing. You need to learn to read the waves, time your entry, and ride the momentum. Section 2. The future of finance, decentralization, and beyond. The emergence of cryptocurrencies signifies a much larger shift than just a new asset class. It represents a fundamental change in our relationship with money and finance. The traditional centralized systems are being challenged by the principles of decentralization, transparency, and individual empowerment that underpin the crypto movement. We are witnessing the birth of a new financial ecosystem, one that is more accessible, equitable, and driven by innovation. From DeFi platforms that offer trustless financial services to Web3 applications that empower users with data ownership, the possibilities are seemingly limitless. The future of finance is about breaking down barriers, fostering inclusion, and democratizing access to financial tools and opportunities. Section 3. Your crypto journey starts now. Take the first step. The world of cryptocurrency can seem complex and intimidating, especially for newcomers. But remember, every journey begins with a single step. The most important thing is to start. Begin by educating yourself. Learn about the technology, the different types of cryptocurrencies, and the opportunities and risks involved. There are countless resources available online, from articles and videos to podcasts and online communities. Once you have a basic understanding, take the next step. Open a crypto wallet, choose a reputable exchange, and consider making your first investment. Start small, diversify your portfolio, and don't be afraid to ask questions. The crypto community is generally welcoming and supportive.